Hi guys, my name is Jason Sari. I'm a financial advisor with the Premier Client Group. I run this channel and I also run a Facebook group, Financial Education for Retirement, on the side, just to help people out with all aspects of personal financial planning. Now, you guys clicked on this video because you want to learn the difference between a traditional and a Roth IRA. And that is a good thing because there are differences and one or the other is going to be best for you. So hopefully this video helps you get down to that as we break it down piece by piece. To start, we'll go over the similarities between these types of accounts. The first similarity is how they're funded, specifically contribution limits. For 2025, for a Roth or traditional IRA, you can put the lesser of 100% of earned income, or $7,000. And after 50 years old, you qualify for a catch-up of $1,000, making the total $8,000 for the year. Now, keep in mind, the aspect of earned income is extremely important. You cannot contribute to any type of IRA if you do not have earned income. You can't contribute to an IRA just based off of income, for example, from Social Security or a pension. You need actively working income to be able to contribute to either one of these accounts. A second similarity is what you can buy in each account. For traditional or Roth IRAs, you have access to anything you could have access to in a brokerage account. ETFs, mutual funds, individual stocks, bonds, really anything you want. This is a great quality of this type of account because, as you know, with 401ks or some other employer-sponsored plans, you can't choose any individual stock, mutual fund, or ETF that you want. You have to go what's provided for that plan. That brings me to my third point. These accounts are completely set up by yourself. They have no relation to an employer whatsoever, as it says in the name individual retirement account. But there's no match, there's no company connection. This is all done solely by yourself. The next similarity between these types of accounts is that the contribution deadline is April 15th of the following year for that calendar year. So to contribute to an IRA in 2025, you can contribute anytime from January 1st, 2025, all the way to April 15th, 2026. Now let's get into what actually matters for you personally that's going to make a difference in your whole decision for this type of account. Now perhaps the biggest difference is the way these accounts are taxed. So a Roth IRA is a post-tax account, while an IRA, a traditional IRA, is a pre-tax account. The Roth being after tax means you get no deduction when you contribute to it. So you get taxed completely on your money that you bring in from earned income, and then you put that into the Roth up to that $7,000 limit. This is a great quality to have if you are in a lower tax bracket currently than you will be at retirement. So just so the math makes sense, if you're in a 22% tax bracket now, why wouldn't you get taxed at this lower rate if you're going to be in a 35% tax bracket at retirement when you are going to be taking distributions from this account? Now with a traditional IRA, it's the opposite. If you're in a 35% tax bracket now but are going to be in a 22% tax bracket at retirement, why wouldn't you take the deduction now, put the money in pre-tax, and then get taxed later on at that lower rate? To wrap together those 2 points, the key takeaways are with the Roth, you put the money in post-tax. So when you take it out of the account at retirement, the money is coming out tax-free. With a traditional IRA, you are putting in the money pre-tax, so you are not taxed until you take it out at retirement. To continue with taking money out of the account at retirement, required minimum distributions, or RMDs, are a very important factor in the decision-making for this process as well. From a Roth IRA, you never need to take money out of the account. Once you put it in, you're good. You can let it sit for as long as you want. But with a traditional IRA, you need to take a required minimum distribution, which is calculated by a divisor based on life expectancy. These change here and there, but the main point is you do need to take money out of an IRA. The government forces you to, or else you're penalized. This is the way the government is able to eventually tax that money on the IRA. With the Roth, the government has already taxed it. They're not worried about it, but they do make you take that required minimum distribution for a traditional IRA. Another difference are the phase-outs. For a Roth IRA, there is a phase-out, which I'll put up in the corner, but if you make over a certain amount of money in 2025, you cannot contribute to a Roth. However, a traditional IRA has no phase-out. You could make $10 million a year and still contribute to an IRA if it is earned income. Moreover, though, another difference is the ability to deduct. I know I mentioned it earlier, but for traditional IRA contributions, they are deductible if you meet certain limits, aren't participating in a 401k, and a bunch of limits that you would have to look into beforehand. but most of the time traditional IRA contributions are deductible, while Roth, since they are post-tax, are not deductible. There are ways around the phase-out, such as a backdoor Roth IRA, but I can get more in-depth in that in a different video because it is a little bit more complex. There are multiple accounts involved, and it's a little bit of a hassle for what can be, to some people, a small amount of money. Again, just to reiterate, most of the time, the IRA contributions for a traditional IRA are deductible, but there are some instances where you probably need to look into beforehand how much you can deduct, can you actually deduct, and all of that, just to make sure you are as tax efficient as possible. Moving forward, however, another difference between these accounts is that with a Roth IRA, you can take out at any age the money you put into it completely tax-free and completely penalty-free. With a traditional IRA, you cannot do that. If you try to take money out of the traditional IRA, even if it is the money you put in too early, you get hit with a tax, the tax you're supposed to pay, and also a penalty. What I mean by this is, let's say you want a brand new car, you're 30 years old, and over time you put in $30,000 to your Roth IRA. Your Roth IRA currently being worth $60,000, you can't take the whole $60,000 out penalty-free. However, you can take that $30,000 out completely penalty and tax-free with nothing to worry about. Now, however, for Roth earnings, you cannot withdraw those early. You do get hit with that 10% penalty, and there are a couple instances where you actually can avoid this, but it is a safe rule of thumb that you're not going to meet one of those emergencies. But again, first-time house and a couple other ones thrown in there to help you avoid this penalty if you really did need the money. Just to end the video off with a couple more similarities, guys, both traditional and Roth IRAs are completely tax-free trading accounts. That means if you do sell a stock and you're at a $100,000 gain, you owe no tax whatsoever. Mutual fund gains, dividends, bond interest, all completely tax-free in these types of accounts. The only time you have to worry about tax is when you are taking money of these accounts at retirement or prematurely to 59.5. Now, lastly, guys, the last similarity is that both of these types of accounts, you can take money out penalty-free after age 59.5. Now, there are exceptions, as I explained earlier, but it's a safe rule of thumb to go by the 59.5 rule, just to ensure you aren't making the IRS mad in any way, shape, or form. So, hopefully you've learned a little bit from this video, enough to make an educated decision on which of these accounts makes more sense for you based on where you are in your life right now, your earnings and your earnings potential, where you're going to be in retirement from your tax bracket. Take everything into account before you go and open up one of these accounts. Otherwise, guys, feel free to drop any comments below that you want answered or leave some suggestions for videos that you'd like to see made. But, of course, let me know if you need anything. Definitely check out the Facebook group, and hopefully I can help you along the way learn more about personal financial planning.